Anyway, so I made, just because I've kind of turned into a social media guy, I made a cute little video about OMD and all that, and just texted it to her, kind of, hey, are you going to go with me and all this sort of stuff? The 30-year-olds around here, oh my God, that's so cringe, dude. She's never going to call you back.
Well, and now here's what is OMD is a band?
OMD is a band, yes.
This is what kind of music?
They are kind of poppy, British 80s. You've heard if you leave, don't leave now. No,
possibly.
Okay, who do you listen to?
I'm like the contemporary bands are like, I had a Jazz Fest weekend where it was like the Avett Brothers and Mumford & Sons, like aging white guy, cool folk rock. It was I was in heaven, like, to see them both back to back. But, it's like now I'm like, so it's like that. And, and then, definitely nostalgia. I have to do my playlist for my 50th birthday party on Saturday night. So
what's the song that's going to get the party going? What is your go-to? And I will fess up first, since we've been friends so long. I'll fess up the invite. I still break out into chills when I hear the riff from "Talk Dirty to Me" by Poison. Nah, 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 nah. Yeah.
The crazy thing about that is like, we remember I used like Poison was thought of as like hard rock. It's like, it was so edgy, or like Bon Jovi, like those guys are those guys, it's like
heavy metal.
Yeah, heavy. I was like, you look at it now, it's like, it's the most gentle pop like you can imagine. But I think, it's probably Talking Heads are going to get people going. That kind of, I'm trying to think, whatever. Yeah, maybe some. What else will get people? There's like Taylor Swift ads, that will be in that crowd, unfortunately, as a 50-year-old birthday party. So that, she's going to get people. What else is going to get people? Did you hear this, like, the new Basement tapes? It was like they found some Dylan lyrics and wrote some.
Oh, really? No.
Wrote some. It's sort of like they did it for that Woody Guthrie album. It's like a whole bunch of people, like My Morning Jacket and Marcus Mumford, did like new songs to some like random, like scratched off lyrics that Dylan never recorded songs to.
Oh, wow.
And there's a song that's gotten a lot of play, Kansas City, that Marcus Mumford did. That's pretty awesome.
I went and saw Mumford & Son. Didn't have a drummer. That was kind of wild. Yeah. Marcus got back up there and played drums on a couple of songs, but yeah.
Yeah, we saw him at Jazz Fest. It was pretty awesome. And then they had, like, he did House of the Rising Sun with John Baptiste and like Trombone Shorty at the end. It was like pretty
I
awesome.
like Trombone Shorty.
Yeah, it was pretty awesome. I guess he has done House of the Rising Sun before. It's like been part of his shtick for a while. But it's like New Orleans. You feel like, you're edgy. You're edgy for House of New Orleans.
You're very cool. Yeah. So Gary, my mom actually watches this podcast.
Okay.
So tell Mom who you are.
My name's Gary Sernovitz. I'm Ms. Yates. Still Ms. Yates?
Still Ms. Yates.
Okay. I'm Gary Sernovitz, Ms. Yates. I had kind of two professions my life. One is I've been working at Lime Rock for 19 years, an energy private equity firm, doing fundraising, business development, investor relations, a lot of other things. Before that, I was at Goldman Sachs with the founders of Lime Rock, but also that time I've been a writer, so this is a fourth book coming out, but there have been 3 novels, 1 nonfiction book about energy, and then articles for New Yorker website, Wall Street Journal, New York Times, on and off. So it's kind of been 2 professions. As I joke, neither of them as successful as I want to be. And so not sure if I failed at 2 professions or half succeeded at 2 professions.
There you go. 1 + 1 is 2,
one,
maybe.
Or less, yeah. And then from, long time, born in Milwaukee, Wisconsin, lived in New York City from week I graduated college till...
Where'd you go to college?
Cornell.
And
just sort of flowed into Wall Street with no interest in it whatsoever. And
that was like a major flex right there. I went to Wall Street even though I wasn't interested.
You're a few years older, but you understand, like, that's a very different generation where I was a European history major. You put a physical resume in a box at Cornell. I didn't get called back. at all. And that was the only Wall Street job I applied to. So I didn't get called back at all until April. And like the jobs were like, I was going to go, I got a job offer to be a speechwriter in New York City for the Parks Commissioner, who was like a kind of a real comical asshole. Sorry, Miss Yates.
Sally Yates raised me. we're all good.
Okay, it's proved. You know, I was going to go to California with some buddies, and then this job I get called back in April from the head of equity research, kind of administration at Goldman Sachs, and like I'd obviously been through the resumes of like people they actually wanted to hire, and found these other just like stack of them. And I had very good grades, but you know, clearly had shown no interest in a career in finance, and brought me down in April. And they walk you around to various senior analysts in the equity research. So it's like chemicals, pharmaceuticals. They brought me a guy, Todd Bergman, and there was 2 senior oil and gas analysts at Goldman Sachs. Todd Bergman, this guy, Don Texter, and Todd was, you know, at that time thought he was, you know, we had this conversation, thought he was like ancient beyond imagination because he had gray hair, but was probably younger than I am today. And he was like, someone had given him very short notice to go on. He wanted to go to, at that time, Russia, at the kind of opening of finance in Russia. And he needed someone in 2 months. And he's like, the conversation was like, you know, I don't know anything about finance. And he's like, do you know how to use a computer? I was like, yeah, I know how to use a computer. It's like, I don't really know any advancement. He's like, do you know arithmetic? It's like, I know arithmetic. And kind of he hired me in like a very, you know, sort of, you know, and I think I would have been hired by maybe others, but it was like a very.
So you go 1 for 1 and land Goldman Sachs?
But the coincidence is like Reynolds and Farber were there in the equity research department at 85 Broad Street.
Right.
So, and they have a very similar story of like Farber was actually given a choice to be the packaged goods junior analyst or oil and gas. And packaged goods analyst was like a very Nomi Gez, like a very big star at Goldman Sachs. Like, I'm going to call the earnings report on Nabisco. That was like a huge deal. And he chose oil and gas. And like, but all 3 of us had like this very similar, you know, time where a, you know, liberal arts degree or general economics degree, it just wasn't what it is today, where, you know, middle schoolers are getting internships at Goldman Sachs in order to get a job. And so it was, you know, so that I got a lot of things in life. It was luck, demographic luck. 50 years ago, you know, here's a fun fact for you, was the lowest live births in American history from like 1949 till today. Like boomers, there's 4 million. Now there's about 4 million. There's like 3.1 million. You got kind of bottom ticked in 1973.
Oh, really?
And so it's not that hard to get college. It's not that relative hard to get into jobs. I mean, all the things you think about, if there's a third more people competing for these limited spots than kids born in 1973. I mean, it was Watergate. A lot of other reasons why it was, you know, Roe versus Wade was 1972. You know, so
right.
there's we will not go down there, but there's
right. Man, I'd never heard that.
Yeah. So it's like it was like an easier time to kind of, you know, and like parents weren't fretting about like, you know, even, you know, getting a job or you're going to move back. You know, it's my parents like, now the one thing about that job, and John Reynolds and I joke about it, he had gotten an offer at like UBS and Goldman Sachs. And UBS was like $31,000 and Goldman Sachs was like $28,000. And he was like, I'm taking the UBS job. That's $3,000 more. And his dad, who's, you know, worked for, you know, kind of a role in, you know, kind of a sales role kind of at phone companies, like, John, you live your life how you want to live it, but I would advise you. $3,000 seems like a lot of money to you at the time.
I mean, coming out of business school, so not just undergrad. My job offer from Stevens, and it was the only Wall Street job offer I get, and I put that in quotes. $26,000 a year,
and it was crazy because I'm sure, and that was in
Little Rock. Great. I was grateful. No,
was it here?
It was in Houston. I wanted to do well, but not well enough to get promoted to Little Rock. That was kind of the way I walked it.
Because the crazy thing, like, you know, just thinking about like generational differences is like I got the job at I made 34. I'm younger. I'm 3 years younger than you. You and John are about the same age. So by that time, Goldman Sachs junior analysts were making $34,000 a year. And like people getting jobs in publishing or advertising were making 24, but they're probably still making,
Right.
40, and Goldman Sachs making $150,000. So it's like you're still part of like this undifferentiated scrum of young people, kind of working,
Right.
but it was not like you were on a different path than it is today. So it was, and I lived with 2 roommates. We had in the city, we had a temporary wall to put in. So we had a 3-bedroom instead of what was effectively a 2-bedroom. So it's just like classic, like young people versus like, you get out of college and you deserve to be rich and get a job at Wall Street, which seems to be what people want today.
So a year and a half later, I got promoted to associate because I started as an analyst. Even though I had an MBA, it was like, man, that was my shot in the door. Got promoted to associate. Salary got bumped to $65,000 a year.
What'd you do with it? What'd you do with all that money?
Literally, all the excess amount in my paycheck went to me buying a brand new BMW Z3 Bonds car. Oh yeah,
very young Houston finance oil bro. That was not an original.
I was married.
Move.
God bless Kim. To Kim's credit, Kim let me do it because I wanted Bonds car. So anyway, that was cool. So do this. You've been at Lime Rock for 19 years.
Yeah.
So level set energy investors. Where are we right now? And I think it'd be great if you put some context into things like, well, 2 years ago it was here, 19 years ago it was here. Yeah. And I'll go to the bathroom, go get another Coke, go get us tacos or whatever, and let you talk for the next 30 minutes. Yeah. But I'd love to give the audience just kind of where we are today, because I think of all the things that us outside of finance or that people outside of finance don't appreciate is just how dynamic it is, how investors think. It's the opaque black box to folks.
Yeah, I mean, you were there, Lime Rock was there, Quantum, the 25-year-old firms, kind of 98. So 98, Lime Rock was founded. John and John asked me to join them as their first investment team associate. I left, said, I'm done with Wall Street forever. Good luck with this crazy, stupid thing called oil and gas private equity. I'll never see you. I'll see you again, but maybe not.
Right.
And so they went on to their first 2 funds. They brought me back in 2004. I saw them at a wedding in Sweden of a guy who took the job that they offered me, another guy we worked with at Goldman. At his wedding, we had like one investor relations woman who they let go. And they offered me, I think it was like $1,000 a week to write their Fund 3 PPM, which is like, I don't know what a PPM is. They're like, you've written 2 books, Gary. You can take the Fund 2 PPM. It's like, it was a very strange ask. And it was and then and I did that, and they said, can you work part-time till the end of the year? And, and it's like the classic frog or lobster in a pot. Here I am 19 years later, and Lime Rock's raised $10 billion. So it's I joke, from 2004 to 2008, it was a wonderful time to have my job. It was like there was the China super cycle. Energy private equity was still not really an industry. There were few firms. All those funds, before that, the great financial crisis, did great. And there was this period, and the shale revolution saw part of it, where the initial purpose of energy private equity, going back to David Swenson, was like real assets. It's uncorrelated, kind of gives you, diversity in your diversification in your portfolio,
inflation hedge,
all that stuff. That there've been a couple periods where that combined with, you got 3x funds, 4x funds. It's like awesome. This is your safe bet that sits next to your real estate, but in fact giving you venture capital or private equity returns. And so there was a period based on 300 million Chinese peasants going to work, and starting to consume a lot of oil and minerals and things like that, China super cycle, where it was people were underinvested in energy. The funds were doing great. The funds had done great. And it was very, very easy to raise capital.
So I talk about that period because I joined Kane in 2002, March 2002. And I tell people about that period, the single greatest thing that happened that in retrospect that I didn't realize was happening at the time is, 98 when Farber and Will Van Lowe and Ken Hirsch and those guys, they're in there in the private capital bucket sitting there going, no, energy, it's better than biotech or buyout and all that. That was hard.
Yeah.
We became an allocation during the period you were talking about. Then it was just like, why me versus Lime Rock? And I used to always say, you should do both.
Yeah. And people were. And people,
Yeah.
People were. The Lime Rock Resources strategy was founded in 2005 because people came to us and said, there's only merit in Entervest doing this. We need a third option. Strategies were being brought into being based on investor demand for put more capital work because, it was, and you remember, not only was energy underinvested, 2008, Matt Simmons, oil's 140, there's a sense it's going to 300, 400, and people were, and this comes in, in generally in energy investing, there's always all investing, but specifically in oil and gas, there's the greed and the fear departments.
Right.
And you can raise a lot of money very easily when you hit both the greed and the fear. I fear my portfolio being exposed to $200 oil price, and I really want to make money doing that. So my first 4 years, was, and we had Lime Rock had extraordinarily good returns on our funds. It's a team that, I've always been very proud to be part of, and it's been very easy all 19 years to sell the product, if you will, because these are people I care about. This is an investment strategy I like. But for those first 4 years, it was CalPERS, we want to put $250 million in your fund. And John, Gary, you just handle whatever you handle the allocation. So I was like, well, we don't really have room for $250 million, but thank you for asking. Thank you for asking. So it was there was, then for the next 15 years of my career, it has been a very, very different market. Now, some of that is Lime Rock going through a natural evolution of any private equity firm, but a lot of that has been, saturation of the market. So you went from, there's 6 OGs, Kane, Lime Rock, NGP, NCAP, Quantum, SEF, then First Reserve and Riverstone are kind of there, but have kind of gone that. It came 35, 40 firms, all the bulge bracket guys doing it. So it became extraordinarily crowded. And then obviously the shale revolution was the greatest thing ever happened to the sector and the worst thing ever happened to the sector.
Well, you had the whole beta story that you were talking about earlier.
Yeah.
Now you were able to go in and pitch alpha too. Oh, with shale, we're going to even outperform. Yeah.
And this is one of the most, objectively speaking, one of the most important things ever to happen to, industrial United States in terms of this kind of miracle of U.S. becoming a dominant oil and gas producer again. And obviously it had some very big wins. And then the two things that also happen is deflationary for the entire sector. So that fear element, if you think about it, shale had the opposite effect. Instead of inflation protection, I joke with Christian Buskin, your number one fan, that instead of inflation protection, you got deflation exposure, which was oil and gas private equity. And then you got, so all your conventional assets were worth a lot less. And then obviously there was the casino element to the industry trying to delineate new areas, some doing it sincerely, some doing it insincerely, some, you're at a casino and just having fun and putting more chips on the board, on the roulette wheel. And so that led to a decade of very, very poor returns for public and private. And that coincided with a narrative in the market, which was, this is judgment, on the sector for oil and gas, and so so there's a lot of funds raised in 2018, 2019, and those funds were still raised pretty straightforwardly. I think that last in 2019, 2020, you saw just sort of this narrative written of it was easy and every institution was hit by 4 horsemen of the apocalypse, I call them. Politics, some sort of divestment, bad returns, extraordinarily highly volatile and bad returns. So it wasn't even just a straight line bad returns. And then lack of liquidity. Still funds. As you know, institutional investors have pacing models, and that based on you're going to return the capital I give you in 4 to 7 years. And that works in private equity and venture and things. It broke in oil and gas. So every institution had.
That's interesting. I don't know that I fully appreciate it because I've always kind of boiled it down. we had the red problem, the losses, and the green problem, the politics you're talking about. But it really did grind to a halt.
Yeah.
Now that you say that, because we weren't sending the money back. I mean,
and yeah, even
we
people
used to like, what is wrong with this company? We've had it 18 months and we haven't sold yet.
Yeah, no, I mean it's and it kind of, so you had all four of those, and you really had 2021. There's COVID obviously, and it was kind of like cringe. It was cringe to invest in an oil and gas private equity fund. And you've gotten through that in a way. So, this year will be the best year for energy private equity capital raising since 2018, 2019. With, Quantum's already raised $2.5 billion. Kimmeridge just had $1 billion fund. We're clipping along between our two strategies, probably have $600 million. It's like it's going to be a very good. The problem is, everyone's basically trying to raise that. So there's not going to be enough for everyone. And this is going to be, it's a survival of the fittest moment. So some of these firms are not going to come on the other side.
It does feel like we have dead man walking.
Oh yeah, you already have, and then you've heard about a few who've already kind of given up, suspended, and you're going to get folks to the other side. And there's some very unfortunate things that's going to happen to their LPs is, zombie funds milk assets for as long as they can, because I'm never going to raise a fund and I'm making $12 million a year in management fees. So I should do that as long as I can.
And you can always talk yourself into a year from now, this will be worth 1.5% more. Therefore, I'm justified in holding it.
Exactly. Yeah. And so you have like a thing where, a few things changed. You have, greed came back in terms of the values post-COVID. Like some people did some pretty amazing deals in 2020, 2021. So as an industry telling people like, hey, we found this corner of Pecos County that we're going to drill 7 wells and flip. It was, we bought this for 2 times cash flow, and it came with those, so you had a greed element then. And then especially a year ago, you had fear, because the same narratives that you really hadn't heard since 2008 of, Russia is going to drop 2.5 million barrels a day out of their 11 million. Oil's going to 200, 300, or the broader revenge of the old economy thesis that you're going to have a cycle away from tech and financial services to energy and mining and things. Yeah, you had a lot of people like worried that my portfolio is, not going to have what's going to be the market leader for the 2020s.
So that's interesting, because when you have a podcast, you say things just kind of controversial so that people. Plus, I kind of always do that anyway. Whatever.
Chuck, yeah.
It's always funny. Sometimes people come up to me. I remember when you said this. I said that.
Yeah.
God, what an idiot. Yeah. But so I've kind of jokingly said we're not going to see what you're calling fear until a CIO can be a former CIO because they didn't have exposure to energy. You actually felt that in the market?
A little. I mean,
okay.
Because,
at 5% of the S&P 500, even if you miss the best performer, have you really risked your job?
Oh, yeah. And you didn't feel like no one was getting yelled at then. But you had conversations in an endowment and like people who are on board, where every endowment or foundation or public pension fund usually has, a politically diverse board.
Right.
And when oil and gas was an underperforming sector, when you had students giving you petitions or pensioners giving you petitions, the guy who sort of liked oil and gas was just like, I'm not going to talk up here, I'm just not going to keep my opinion. Because like in Barry, I think now you got conversations had reached neutral. It's like, hey, that guy's speaking up. It's like, listen, we have not made an investment in this sector for 8 or 9 years, or 4 or 5 years more likely. Should we be thinking about it? That was the first step. And you did have a little bit, no one fired, but there was like a very interesting Harvard Management's fiscal year 2022 letter came out in October, and in college endowments have a June 30th fiscal year. And it's only like a 2 or 3 page letter. But above the fold on the first page, an old newspaper talk, was a paragraph about how we didn't have oil and gas exposure, and that's why we underperform versus those earth-hating endowments who did better than it. And it was like benign. But like the fact that was so prominent, the 6th paragraph, I think it was, in the first half page you read, was a sign that like the fear was coming. That was a good warning sign. The fear is coming in the market. Over this year, greed and fear have dissipated a lot. As oil's gotten to more benign, it's now rising into the 80s again, but it was in the 70s, but it's getting to the 80s because Saudi's restricting production. And the other thing is like the market, for new deals is interesting, but it's not like 2021 where, there were just like nickels on the street of Houston that you could pick up, because, there is capital out there. And like sellers, if your pitch is like, you should sell me this at 3 times cash flow, because I think oil's going to be 100 in 5 years. They're like, well, it's 3 times cash flow and I have 7 pumpers. Right. I'll just sell it in 5 years when oil's $100. So you have some properties transacting, but it's reasonable prices, but it's not a market where, I think energy private equity can go and say, this is the easy time to raise capital.
That's been my sense, is that most bids lose out to, I just don't want to sell, because you've cleaned up your balance sheet. So you're not the Walking Dead anymore. You really don't have that kind of shiny, sparkly use of proceeds to go do. I don't, nobody wants me drilling that much.
Right.
So I don't need to sell this field and deploy the capital there. So
one unnamed private equity firm has a pitch deck that, you get to see these kind of things occasionally. And it's sort of, we have these X number of companies that are generating billions of dollars of free cash flow, but give us billions of dollars as those platform guys. Like, they don't actually need your new money. To your point, like, they're doing very well. If they wanted to buy properties or drill a new well, it'd be more actually accretive to your initial equity investors to just have them go do it. If there's these opportunities. So there is sort of and so it's, the business on the new capital side, still opportunities. There's always competition in every investment sector. So it's not like there's ever going to be this like miraculous 10-year period where every private equity firm is just going to easily make money. It shouldn't, I think there's a Charlie Munger quote, like, this isn't exactly it, but like, investing isn't supposed to be easy, right? Which is like, it's not that's not going to be the case. But you do have now sort of firm, it's a grind, but it's better than it was a few years ago. I mean, infinitely better than it was a few years ago, where it was like, firms had made very conscious decisions to end being in the oil and gas business. I think Lime Rock, we're very happy that we kept Lime Rock Partners, Lime Rock Resources doing exactly they've always done. We started an energy transition growth equity strategy, doing like EV charging installation, that kind of stuff. But I call it like the Norway model. Like, those guys, different team, they're wake up every day. How do we accelerate the energy transition and stop the use of oil and gas? While the oil and gas strategy is like, we're going to invest money in oil and gas to make our investors money. Norway exports 1.5 million barrels a day of oil, but they, have 60% penetration of EV. It's like, God will judge the Norwegians in Lime Rock. So like,
we did. So as we were talking in the car on the way over, the girlfriend's British, and she has
your girlfriend.
My girlfriend's
just
British.
For my wife is watching this. I want to clarify that.
Let's clarify that. And she's chastised us on big digital energy because we talk about Europe as a uniblock. And she's like, it is 25 to 30 countries. We're all different. So what we started doing on BDE is we would actually deep dive a country each week and go through energy use, et cetera. And when we went through Norway, what's fascinating about it is, you're right, they've got all this oil, they've got all this money, electric vehicles are 60%, 70% of it. They're actually using as much oil as they ever have. I mean, that's the dirty little secret of.
And like, no one's stopping exporting it too. So so I think what we so back to the market today. So they're clearly, most of energy capital raising is like, it is open for re-up with your existing partners. So I think that is pretty standard now. And there's a little bit of unjust serendipity involved. Because what happened with divestment, what happened with the 4 horsemen of the apocalypse, it isn't necessarily your fault. University of Michigan, longstanding public investor in, I think, Kane, right?
Right.
And Lime Rock. They had students, on the, at the regents meeting, like banging on their car, not letting them go to vote to divest. They have come out with a policy not to sell, but just never invest again. They were our largest investor in the last fund.
No.
Versus, a state of Florida or a Texas pension where actually has the opposite pressures of like DeSantis or Abbott, or like making oil and gas private equity commitments is good for my political real life. I was like, thank God, I would like to have more of those. And so there's a little bit of sort of luck involved.
Right.
But I think re-ups are clearly happening with happy investors. And generally, I think most private equity firms, on average, about half of your 2018, 2019 fund, if you're a responsible, deliver well, and a lot, and our funds have been very good over the last those periods, in a vague way, SEC,
yeah, exactly.
But I think re-ups is kind of that, and then the issue is like the war of all against all for the very rare investor who's like doesn't have exposure to oil and gas and wants it, or like wants to add groups. Because most people, even if they're re-upping, they're actually quietly, taking the unfavorite child and like putting a pillow over its face and re-upping with their one or two favorite ones.
Right.
But like the joke of it, I've been in this business for a long time, and I'm friends with a lot of our competitors. People do the same role, and it's like, you get a couple beers with them and you're like, you're going to the same cities, you're going, it's 70, 80, kind of real institutions that may put one new name in the portfolio this year. And
and they're the prettiest girl at the dance and they know it.
Yeah. And then, and they also, I was joking. And then there's a lot of like sort of family offices that had liquidity events and kind of have a reason to want to be in oil and gas. But, and that's a lot of the new source of capital. But those folks, as I was joking to someone yesterday, giving up all my standard jokes here right now, I'll have to come up with new ones. It's like,
that's all podcasting is.
It's like, I'm milking a lifetime of material. It's like, my job is like, I'm selling like Delta One tickets to Europe, like flatbeds, amazing. I've never been on Delta One to Europe, but I think, I assume from my seats, I think they look very nice. And I'm like selling very, very nice, long, all the good things about Lime Rock and things I believe in. It's like, I'm like, this is going to be the best time you're ever going to get to Europe on this flight. And some of these like $3-4 billion family offices, it's not the principal, but even the chief investment office, like, we don't really fly commercial here.
Yeah.
A rich guy family office, like we don't. Yeah, so like a blind pool fund is Delta One, to Europe, where they're wanting like, do you have a secondary for us or a co-investment for us or some side deal for us? And then maybe, so I think the challenges of those names doing it, there's a certain edgy contrarianness to those names that kind of want to come into this market. And I think there's those guys also have a kind of an edgy contrarianness against private equity in general, which is like, where, have all the, it's just not cool, right? To be in a blind pool vehicle with, a state pension fund.
Right.
And it's like, probably even those state pension funds have done better performance than you have over your history by not trying to be cool. It's still, there's still that agency problem, as David Swenson, kind of made famous.
So the discussion with existings today, and I'll just ask a question and you can answer or politely decline and tell another one of your jokes. But are we seeing, I would think we're seeing existing investors go, okay, where am I on energy? Where am I allocated? And so if historically an investor did 100, they may be coming to you and saying, well, we only want 15 because we actually have. So allocation, I think, is a big issue talking to existings. Any pressures on fees? Is that playing into it or I can't believe you'd ask me that, Chuck.
Well, I think I think that is done more through non-blind pool stuff. So amortizing fees with co-investments or secondary. So it's done less of like, you should charge 1 in 10 for a blind pool fund.
Right.
Than, hey, what can we do besides this to have over our complete experience of Lime Rock? Kind of a lower fee burden. And I think there have groups that have been tried to do like accordion funds and things like this, which is like do 50 in this fund and then 50 in this other fund that has no fees and carry. And it's like, well, what is the difference between the two?
He used to have that discussions with some powers that be in LA. And it's always like, we need to do this, the sidecar and all. I go, I'd rather just cut the fees.
Exactly.
Just do that.
Yeah. So
if that's what's stopping us from raising money, let's just cut the fees.
And I think for a lot of it is just, a lot of discussions with existing investors has been really, it's not, they're happy customers. It's just like, hey, what is our allocation to energy? And sometimes, it's because of their allocation to Lime Rock. Like, and we have we have to get it down to, 6-7% from a leading endowment at 8% energy is like way out versus, probably 3%, probably now more standard. So I think some with the,
in the heyday, did we hit 12, 13? Yeah, it felt like we did.
I think there was for real assets, but most of that real assets was oil and gas. Yeah. So I think, that was definitely, and the other thing is like a lot, there's a turnover of people too, because endowments always in foundations and pension funds are always getting new, it's a relatively high turnover business. They're always getting new CIOs, and generally they have a new team. And a lot of times they're like, well, I have the managing director of public markets, private markets, or maybe sometimes credit, sometimes real estate. It's like, there's the energy. Why do I have a managing director of energy?
Well, that was going to be a question I was going to ask. Is when we went into shale revolution, the glory days you're talking about, you had real assets person, and they were an energy person, and there's some folks out there that, were full-time energy folks and really understood the business really well. Does that job exist today?
Very rarely. Generally that person. People are learning on the job. But generally, very rarely does like a big endowment have someone, especially oil and gas, like almost none has it even like your alma mater, John Lawrence, does other things, besides oil and gas now, in terms of, but probably the leading sort of, given his background and stuff in that, but very, very rare.
Because you think about that, Michelle Everard retired, Amy Diamond's now CIO of USC, and so
there's definitely like a sense of like, did you go to Michelle's retirement party in?
No, I could not make it. And I was so bummed that I didn't.
There was definitely like a sense of like, Fredo, I know it was you, kind of like it was actually over, sort of like the real assets, oil and gas. Like everyone was there, everyone was in the room. Like
let's all hug it out and cry.
Verna kissed Amy. Fredo, who knows what would happen, but it was definitely like looking back on that moment of like sort of I think it was 2018, 2000. It was like the peak of sort of like happy things where there's a lot of exits in 2018, 2019, and just sort of like peak happiness before COVID and before like a sector really turned over in a lot of the divestment.
Because I talked to Verna Quo last week, and I probably talked to her for about an hour, and we talked to my dating life the whole time. We didn't even talk energy.
What's more complicated?
No, it's not. It's very simple these days. Sweetie, I only have eyes for you.
Yes.
No. Sweetie meaning the girlfriend, not Verna.
Verna. Okay. Yeah. No. It's. But yeah. So I think it's. I think it's a good.
So does that pitch? Or those discussions, I guess it entails some re-education in terms of things.
And I think the one thing that, there's a very clean story that I think a lot of our peers are telling, which is like the oil and gas business is like devoid of capital and oil is going to go to 200, sort of like, and it's like, and then occasionally the investors will recognize, like, didn't Exxon report record earnings last year? And don't they have more money than they know what to do with in terms of free cash flow that they're not earning back public market, enthusiasm through dividends and share buybacks? And like every CEO of every publicly traded oil company is like, I've done everything you've asked and you still don't love me. Yeah. But it's not because the oil business doesn't have oil. It's the financial markets still discount that cash flow at a crazy amount. But so I think you have, our pitch is like, it's not just this like, like we are not as an industry supplying enough oil and gas that the world needs. Saudi keeps on cutting back production because we're supplying too much as an industry to do it. So it's the education. And this is, you always have this, and I'm sure you remember this, you always have this like challenge in this job of let a conversation take the simplest form so it can move on to other things, or try to get very subtle where the complexities around why there's value in energy are not just, it's cash flow use, it's strategy, it's geology, it's service availability, it's some energy transition, but it's also in the future because there's not a limit of supply right now or really limit of capital investment necessary, even that could happen next year. It could happen, 5 years from now. No one really knows. So I think there's definitely a re-education on that because, interesting, a lot of the people who come to us, incoming, still have that greed and fear, like high, that they're like doing a market mapping. It's like, yeah, I heard things are 2 times cash flow. You don't have to underwrite terminal value. And like the industry's bound to be $100 oil, at the end of the, I was like, let it be so, sister. Let it be so. But it's like more complicated than that in reality. Right. And so I think the conversations now are re-ups, kind of good partners. It is a good time to be investing in this sector, even if there's still competition for an asset. It's still a market that's trading at 3 to 4 times instead of 7, 8 times. Right. There's still cash flow versus just, sort of selling enterprise value or locations or delineation or things like that. So there is clearly de-risk, less leverage. There's a lot that, but at this point, it's making that case sort of like a solid, this is a solid investment opportunity. This isn't like not the greed and fear or not. This is not like we're offering you 7Xs or you're going to get fired if you don't do this. And then I think at the end, the issue is like, of these groups that are still looking to they're like, when are you closing tomorrow? Yeah. Or, let's wait till we have to make a decision and see if someone hits me with a co-investment or hits me with, as a fund that already has a pending exit that we can.
That was the most amazing fundraise.
Yeah, that's going to be on
Fund 7.
It's going to be on your tombstone.
We raised $900 million in 6.5 weeks because of the front page article about Silver Hill being for sale. Yeah. No. So I think and that's a very rational thing to do, because the nice thing about private equity as an LP is you can be in the final close. Yeah. And there's some economic impacts of it. But you can also, in certain cases, if it's gone on, have a view into a portfolio that you otherwise couldn't, and have some fun of like sort of an immediate write-up and stuff. We used to, what happened to us to give the impetus is, I think we wound up giving a 50 basis point hit on, or reduction of fees for the first 2 years if you'd be part of the first close.
Yeah,
I mean, we had to put stuff like that out there because people were like, well, I want to see what you invest in. Well, I don't have any money. Yeah. So it's really kind of hard.
That's
kind of hard.
Yeah. The nice thing about doing this for so long is, there is turnover, but there's a lot of people who have still been doing it. And you can be honest. Like, why should I do it? It's like, well, it's good for me. It makes my job easier. Not good for me personally, but it would, we've been good partners and it'd make our life easier if you do it. And like a lot of times we're like, okay, we understand. Yeah, and then you have some economic incentive, but you kind of need that in this business.
So on the scale of the bar just opening, which is kind of like everything's tame, quiet, nothing happening, to drunken sailors at 2 a.m.
Yeah.
Where are we fundraising? Is it maybe 10 o'clock? People have had a drink?
I think I mixed metaphors. I was doing 1 through 10. So, sorry, okay. Bars. Oh, bar. Oh, the bar.
The bar, like bar's
the
opening
bar,
is
the
1.
Bar. Okay,
the bar opening is 1. 10 is drunken sailors at 2 a.m. being kicked out. Where are we fundraising wise?
I mean, I think 5 through 10 will never happen again.
Okay.
So it's like 3, 2.5, 3.
Okay.
So it's like people are ordering drinks.
People are ordering drinks.
But it's more, they're at tables. And it's it's like a 70-year-old couple ordering an expensive glass of wine rather than people thinking. And again, it's and then the one thing probably on this story that I joke to people is one nice thing is energy private equity's relative difficulty compared to general private equity has not been this narrow in a very long time. And that's because energy private equity has come off from impossible to just annoying. And general private equity has come down a lot.
Yeah.
And that's come down. The denominator effect, who knows? Public markets have rebounded, so who knows? But that's also like what general private equity did to LPs, during COVID and before that, of like, Tiger Global, like they're raising a fund, and then they're actually like talking about the fund they're going to come back with 7 months later while they're raising a fund. Like, you can be in this fund, but if you're in this fund, you can be in another fund in 7 months that we're coming, and just the amount of commitments that general LPs did to private equity that have now not been called a lot because the markets, IPOs haven't been good, and there's just not a lot of activity in M&A. It's actually quite difficult in private equity. We're seeing that a little more in kind of renewables. Like, you've come off of sort of this, amazing sort of, desperate need to be in it. Maybe that was the drunken in the bar and kind of renewable power 3 years ago, which we're not in, but that sort of subsector. And so you now have energy private equity. Like, we're waking up, we're like, trying to extend a bar metaphor, and it's like I just came out of rehab. I'm now presentable. I look, I have the scars on my face. I've showered. I'm ready, folks. And like, you come into the bar and it's like a third full versus the bar before you went to rehab, you kind of realized was always full, and that's just because it's I think roughly speaking, half of private equity commitments that are going to be, for an average investor than they did before, just because of overall portfolio dynamics. And energy is no longer, it's now like you'll do energy along, a lot of them, it's sort of best athletes or just kind of general private markets. You're just kind of in the scrum with everyone else. And so
back to where Ken Hirsch was in 96.
Yeah. It's like a thing. It's like a weird sector, but like people do litigation finance. Like, there's some weird shit people do in private markets, and that's one of them. And so, but in that, it's, if people are trying to shrink their capital, not to, in terms of deployments.
Right.
And we'll see what happens if people feel confident about this public market rebound. And suddenly, like, we haven't done a commitment as much. You could enter a period where people have to play a little catch up, but that would also be depending also on public, general private equity exits.
So do this. You always have the standing invite to come on the podcast, but we'll for sure do this, call it 5 to 7 years from now.
Okay.
What are we going to be talking about in 5 to 7 years from now that maybe people aren't thinking about today? I'm forcing you to look into your crystal ball, and I'll go one.
Okay,
I'll go one on this so you can have time to think. And plus, I don't mind embarrassing myself. Yeah. I think, and I've become fascinated with this as an investment thesis, and I talked some to Verna. That's actually why I called Verna. I actually think we're going to see kind of the rise of power, electricity, as kind of the oil of the last 50 years, if you want. All the things you were saying about oil, it's your inflation hedge, it's driver of the economy, fear, you've got to have this. I think we're going to see the same thing with power rising, because if you think of electricity, we use just over 4 trillion kilowatts a year. And it's grown. It's up 14x since 1950. But if you look at it, kind of since 2000, if you look at the slope, from 1950 to 2000, it was like this. The slope's been a lot less. It's grown over the last 20 years. I think one, that was just, we spent a lot of money getting Y2K stuff done. So you kind of advanced, you pulled forward some of the demand. Number two, we just got, we spent a lot of time during the 2000s making machines way more efficient, a lot of stuff. The Bitcoin miners won't admit this, but the machines, they haven't gotten any more efficient over the last 2 years. So I think that stuff's gone. And I'll throw one stat at you. If you run a Google search, and I do 100 of those a day, right? 1 kilowatt. If you run an AI search, the same thing, 5 kilowatts. Or no, I'm sorry, 1 watt for a Google search.
Yeah.
5 watts for an AI-driven search. To train that AI language model to be able to run that, anywhere from 100 watts to 1,000 watts. AI is going to be embedded in everything we do going forward. So when you look, I think McKinsey says by the year, and I'll get this wrong, I think it's 2045, we're going to use 2x the amount of electricity. Elon Musk says 3x. PG&E's official report is 70% up. I think
what time period?
Until 2045. Yeah. I think we're blowing through all that. I think it's 10x through that, because it's just, and it's going to wind up being the thing that you in the portfolio, that's your fear. Oh my God. Because say what you want about oil. We can always drill a well in Texas. Always drill a well in Oklahoma. Power, we got to build a power plant. We got to connect it. There are engineering issues to get it on the grid, regulatory issues. Anyway, so that's my thing I think we're going to be talking about.
We have some insight into that through like our Lime Rock New Energy. 2 of the portfolio companies were kind of grid modernization businesses. The one thing I've learned, because I'm by accident like an oil and gas guy,
right? And
and I feel like the BP statistical review, which is not the BP statistical review, but the statistical review of world. When that opens up, it's like, this is fun. Like, I've been looking at you for 19 years. I love going. I have like this intuitive sense of oil, or someone tells me $1 per acre number. Like this sector, which I've had to learn over I've had to learn it, and you realize I'm also a lot older than 25 or 27 years ago when I started learning oil and gas. It takes a while. One thing I've learned in there is how unusually fragmented it works in the oil and gas business that may not be as applicable to power. Because you think about it, like an average Kane Anderson E&P company, 30 people?
Oh, 5 guys in a rusty pickup truck.
Yeah. But 20, and if they drilled some wells, they had 25 pumpers, right?
Exactly, yeah.
Yeah, and then service, the amount of like different levels of service companies. Like, I don't want to use Schlumberger. They're not going to ignore me, or I'm going to, So there's a level of entrepreneurship. There's a level of fragmentation, a level of kind of almost like virtual companies that you have with an E&P company in particular. That power is really, there is an advantage, especially it's dominated by utilities, especially the capital cost. Like there is is this a great sector for private equity? Think about deepwater offshore. Is that
that's exactly what I was saying.
So the question for us, and like not as like human beings, like what are we going to do, but as like investors, there is something well suited for super fragmented, also volatile. If you're on the right side of volatile, that's either fatal or a good way to make money. About what you can do with that. You just kind of utilities have other things besides making money. For as a consumer, you want them to reliability.
Grandmother stays alive during the winter.
Yeah, and like and price. And also there's issues of fairness and pricing where I have rooftop solar in my house, but like the poor guy in Louisiana in the apartment, is effectively buying my net meter. Are they effectively helping to pay for, so there's like issues that, and they're not, utilities, they're what you think they are, in terms of, they're bureaucratic, slow moving, conservative businesses. But the issue in like power, where's the hustle? And then the other thing is like, this is not gonna be a perfect, are we going to sort of socialize reliability in a way where the hustler can put up a wind farm or a battery, and that the utility is the one who's going to have to make sure the lights are on by this gas peaker plant and that? So how do you manage like society's, kind of ability? Because that's like the fundamental, and it just drives me crazy, debate about like levelized cost of electricity, where the green guys are like, it's, incrementally cheaper. So like it's a no-brainer. The oil and gas guys are like, yeah, but you're relying on an existing grid and existing, intermittency solutions and gas peaker. And then, so that isn't really your cost because you're just sort of free riding on that. But then the green guy's like, well, that already exists. We don't, So it's like, it's a very challenging thing. So I think, there's probably a reason why to date, there have been 80 oil and gas private equity firms, some RIP, but like 5 power private equity firms, in terms of like pure play.
And so this is fascinating talking this. And I should tell the audience, I may wind up doing something here because I've been thinking a lot about it. Is I actually think the product that needs to be available to folks is pure just beta power price. I had Tim Kramer. I don't know if you've ever met Tim. Tim has the only ETF or mutual fund that has direct exposure to power prices.
Oh yeah, I do. I have met him. He's actually been on my porch in New Orleans. Like,
have you really?
We have a mutual friend. We have a mutual friend.
He came on the podcast. We talked about that, and we've actually killed way too many brain cells over too many glasses of wine thinking about it. But I think he's right. I mean, because of all this, what I'll call stickiness you just said of how we're going to get more power onto the grid and actually get it to people. I mean, higher price is the only thing that does that. Yeah. And I think the flip side is if power prices don't go up, electricity prices don't go up, you're going to have the economic boom of all time, if we're actually able to feed the electricity to everyone.
But I think one thing of the shale revolution that's been the only probably disappointing besides equity returns to oil and gas company holders is like reindustrialization of the United States, has not happened what I think people thought 10 years ago.
Yeah.
And that's one of the reasons energy use has gone down in the United States because, this microphone is built in China and, where it used to be the energy used to build this microphone. Now to run the microphone is state of Texas, but it used to be to manufacture it. So
we had the chance to do that. And instead we just send Amazon vans 3 times a day to our house. That's what we did with the shale revolution. Yeah. Interesting. So, all right. So your crystal ball, what are we talking about in 5 to 7 years?
I think much more international.
Okay.
Like there's no question the shale revolution has matured, and there's no question that if oil and gas meets even slightly declining demand, it's not coming much more. There will be an active thing in the United States, but the United States is maturing, consolidating, and really where the entrepreneurial energy will be is internationally, and it's really difficult because resource ownership, corruption, it's E&P internationally. I mean, we've tried. And
this is so true. I've done a deal in California. It's horrible.
And so, so I think that's going to have to be part of, and does the international, what has to happen will happen. It's sort of cliche. Like at some point, if we're going to use 100 million barrels a day of oil and 350 BCF a day of gas, that has to come from international unconventionals at some point.
We've hit everything, I think, in the United States, every rock formation with the bigger hammer.
Yeah.
And I don't see a technology out there that I could kind of draw a straight line to, this will increase production dramatically. I don't see it. Maybe there is one
the technology, you see it on your Bloomberg, which is like $110 oil, right?
Yeah, exactly.
So there is like a scenario where that the incremental risk you need to do, Peru, I'm just make up a country.
Yeah.
Peruvian shale, Peru exists. Just I didn't make up Peru, but Peruvian shale. Probably the Powder River Basin is going to be working if, because oil's $110 a barrel for risk. So I think internationally is going to be much more important. I think the industry is going to be a lot smaller for sure. And I think it's going to return probably to 2002 where, it's finding value in very localized pockets of growth that is going to be most of it. The big question that no one has solved, and whether it makes sense in a public market, whether it makes sense in a private market, is like who's going to be the terminal owner of the shale revolution in the United States? And is it the Lime Rock Resources, the Merits, that it's like, we're going to change the business model to own it forever, the Scouts, things like that? Is it, this KKR vehicle. I think it's Contango now or whatever, where it's like public, and to avoid the MLP messiness, but do that. But I think that's also a huge thing that, it just could be throwing out a huge amount of cash flow. And the one question is, does Exxon just want to own it? Because Exxon's going to be like Philip Morris. It's like, we're just going to give out high dividends and keep it flat. And we're going to have enough people who are going to like it that we're going to make a lot of happy investors. Or does that have a shift towards private hands? Unclear. And maybe it's a supply demand of capital issue. I'm not sure.
No, that's an interesting point, because that is the one thing that I've heard from folks out fundraising that I never heard when I was in the game, is there's a real discussion. And when Eric came and spoke at our Empower conference, Eric and I talked about it on stage, is, do investors really talk about tails and not being valued and potentially regulated out of business? And that's a real thing.
Yeah.
In terms of at least a discussion point that never before.
I mean, clearly the public market is not valuing their tail. They're valuing it 3 times cash, 4.5 times cash flows. They're clearly saying this is worthless. And if it's worthless, does Conoco want tens of thousands of, stripper wells, 5 years from now? Probably not,
Yeah. No, that's interesting. So, all right, I want to hear about the new book.
Yes.
And you were kind enough to send me a copy to it. I read it when I was in Sardinia, laying on the beach, in between bottles of wine, not even glasses of wine.
Each copy comes with a free trip to Sardinia on Delta One and unlimited wine just to get through it.
Exactly. So give me the thumbnail on the book. Tell the readers or tell the listeners what the book's about, and then I got questions.
Okay. It is a novel about the chief investment officer of a kind of an unnamed and imaginary college endowment. And it is trying through a very, very 4 difficult months of his life in a novel set exclusively almost of trustees, of asset managers, of hedge funds, of his employees, set in conference rooms on telephone calls. It is trying to get where investing is not like the background of the novel, but investing is really like the moral drama of the novel. And as this person's wondering, how do I succeed? How do I fulfill my purpose as a person? And like all good novelists, I'm just torturing him with kind of bad news and challenges. And then it ends.
The hero's journey. I mean, it's classic Joseph Campbell's hero's journey.
And it ends in like a very, very long scene where he meets with this college's most famous finance alumni, one of these like big 100th richest men in the world, hedge fund guys, who's like a very reclusive guy. And it ends with like a very, kind of pattern a bit after the Grand Inquisitor scene in the Brothers Karamazov. It's like trying to be like get to the, the essentials and like unresolvable essentials of what it means to be investing, to be alive, to care, and all that kind of stuff.
So I may be reading my own biases into this, but I'm going to say some stuff and tell me if I picked up on this or no, I was making it up. The one thing I think you did really well in the story that I don't think people appreciate, particularly within the cone of the energy sector, is you make the point that investing's a relative thing, right? I mean, I hear all the time, well, I can buy PDP at PV15 today. That's great. And I'm like, well, if Apple stock doubles next year, that's not great. Yeah. And you did that. Did I pick up on that right? Were you trying to say that?
Yeah. I mean, maybe the only audience will be people in energy private equity, but hopefully we'll get at least 100 more readers. So I was like, but I think it was very systematic to try for both dramatic purposes, but also try for this to be kind of like a primer for like the guy I was coming out of college knowing nothing about finance, of like trying to give an exposure. Here's venture capital. Here's hedge funds. Here's
real estate.
Yeah. Here's like, and because that's like pretty interesting about investing, where it's not just, hey, and there's like a very brief scene with our minerals fund in there pitching them, but it's like minerals fund. Yeah. Well, what about like just like having exposure to the Indian consumer through public stocks? Like that's what they're thinking about. Now, sometimes, and this is purposely a smaller endowment, it's about $6 billion. And I play a lot of games that amuse myself. It's like people think, oh, that must be Brown. It's like, nice. You can't be Brown because I mentioned it's not Brown or Cornell, Rice or UVA or things like that. But it's like a smaller team specifically. So the organizing brain in it and the team is small. So they're constantly having to compare, hey, this guy says, early scene, private credit. It can deliver low risk credit for, deliver 10% returns, 2% origination fees, 8% interest rates, and he'll never lose, and it's like, I think every investor always has this thing where you're out there pitching 2.5, 3x funds, but then someone's like, if you were given a button and you could generate 10% zero risk returns for the rest of your life, most people would push that button.
Oh, heck yeah.
Yeah. And, so it's like, it's a sort of trying to get that drama in, but also have it so just like people understand like what this life is and how these same themes resonate. And they're not just themes of specific investment strategies. Like, is this person honest? Is this person hungry? Is this person, do we tolerate that he's an asshole? Do we like it that he's an asshole? Do we do we like that he's a windbag? Is it, and is he just, and then the big one, as you know, is he just fucking lucky? Yeah. Sorry, Ms. Yates. Is he
my mom.
Yeah.
She survived it.
Is he just lucky?
So real quick on Sally Yates. We're sitting there at dinner one night and I'd just gone and seen a comedian with my brother and my sister-in-law. We're telling Mom about the comedian. And my sister-in-law was like, yeah, the comedian was funny, but just cussed way too much for me and all that. And I really hate the use of the C word. That's not great. My dear sweet mom goes, oh my God, he said crap. True story. But so the first podcast I ever did, I had 2 anonymous folks on from Energy Finance Twitter, and they were giving me grief about, you guys just didn't make that much money. You invested all those dollars, you didn't. And I don't think they appreciated that, hey, a CIO is sitting there going, I've run the scenario where oil prices collapse. I've run the scenario where oil prices triple. I need X amount of exposure. So I don't want to sit there and say, I'm so great and all that sort of stuff. But my job was to get them that exposure. That was a key element to it. You want to make money. And they said, no, you should want to make money on every investment you make. And I go, do you want to make money off life insurance?
Yeah.
Seriously.
Yeah, and it's hard. And that's like the one thing.
But I'm cutting you off and I'm sorry, but you really did a good job of the CIO grappling with that. And I think that would be value add for people to pick up from the book.
Yeah. And it's like, and there's like an organizing, and that's maybe just my own ethics or just point of view to less pretentious. You always want to be more pretentious on occasion, but it's like,
I'd love to be pretentious. Yeah. Just one day.
We're going to talk the rest of this podcast
like this. So the British girlfriend, her line is, we invented your language and we really don't like what you Texans have done with it.
Oh.
So I was like, okay.
Oh, let's hear your British accent.
It's horrible.
Okay, got it.
It sounds Australian.
But, I think, so, the novels about Wall Street have like a very specific lane. They're thrillers. There's a lot of Russians. There's a lot of cocaine. Yeah. There's a lot of prostitutes, and there's always some murder. And it's like, its attempt to glamorize it is one lane. And then general novels tend to get rich people in it, and they have to have jobs, right? So like a novel about New York City rich people, of course there's going to be guys in finance, and the author's going to do research. So he usually will sound kind of like 40% off, but at least he's 60% right, just saying Global Investment Inc. The guy is and I once read a novel of a friend who asked me to do this at a character. I was like, this guy is like an investment banker, hedge fund, private equity. It's like, he's the best of Wall Street. Like, you have no idea. This guy does not have a defined job. You just throw random words and you think about. So I think one of the purposes of the novel was, and it's almost like self-defeating, was like, de-glamorize the business in a way. And, there's, very, and there's no scandals. I mean, I think as I think about things I regret, like the worst people are kind of assholes and windbags, but not actually grifters. I mean, maybe one.
But that's actually probably closer to reality.
Oh, yeah, no, that's 100%.
Yeah, because
100%. But it's like, as, when you go to a New York City publisher, like, we want the grifters. We want Adam Newman, and we want Bernie Madoff. Like, this is what we think. And like, this has to be a page turner of and we want them to be in Sardinia, at the Gucci store, dropping $75,000 for, sandals, or a bag to store their cocaine, So it was like, So I think part of the novel, I think it's trying to be funny, short, it's like fast, but it's like, the challenge that had been as like an economic entity is it kind of doesn't really play into the expectations people have of what they want, which is like rich people unfairly getting their money kind of by cutting corners and then behaving badly. This is about, generally speaking, just sort of like, a difficult thing of a guy who takes his job seriously with no easy answers,
I had one other thought that came out while I was reading the story, because like we just talked about, CIO sits there and goes, macro wise, I need exposure to the Indian consumer. I need this, that, and kind of lays it out. And then within that, it's, how do I play this? Yeah. Which manager do I go with? And I don't know if you made this point or if I just, again, kind of read my own bias into it. It felt like because he said, I want to generate some alpha within my beta bets, i.e. I want a top half or a top quartile manager within it. It almost felt like you might have been saying in the background, chasing alpha is leading you to take more risk, and you might be damaging your beta bet. Did you say that, or did I kind of read that into
There's
it?
Like a very specific case where, in that one manager, and again, this is not like I think I have one Chinese ETF that I don't even know why I have. Just like, but it's not like I'm an expert on Asian long short strategies, or know anyone who does it actually. Yeah. But it was like, there is a scene in there where it's like, hey, I know this is, when you think about a pool of capital that'll be around for hundreds of years, like most college endowments probably will, I should have exposure to the Chinese and Indian consumer. But I did it before with some guy who made wrong bets.
Yeah.
And it turned out that I was, in that case, he was just talking that, and again, the book was written, there was a period where like, it was sort of like the FANG equivalent in the US, where all the market appreciation was going to big names. If you did that in China and India when the same thing was happening, or Brazil, you would lose out all of these things you want. And it's just like and so there's a lot of sympathy for having to do that. And there's also, a through line through the whole book, which is like, maybe you should do nothing.
Yeah.
And the one true scene in there is like, Jack Bogle, kind of meeting when the CIO meets it. Like, I once sat for like 45 minutes in Jack Bogle's office with John Reynolds. And so that's the one, like, and it's not perfectly accurate because I didn't take notes or anything, but, kind of pretty memorable. But just sort of like that of like, well, we have figured this out, finance. Where sort of passive broad exposure works.
Exactly.
And like, what do you guys do for a living? Oh, yeah. You're basically trying to undermine what I've been proving for 50 years to be the case, which is passive broad exposure works.
And because I like that point in the book, and I will go ahead, and since it was such a funny line, your buddy John Farber, I made that point one time. I said, when I think about energy private equity and chasing of alpha, I think it led us to take more risks than we should have, and maybe destroyed the beta benefit. And he just said, well, Chuck, you've never generated alpha, so you wouldn't know. I was like, seriously? Thank you. Really appreciate that. All right. One of the most mortifying things on the planet is when my dad retired, he started writing novels, and the novels have sex scenes. So I will
about him and your mother, or like
so he's kind of got his stuff is kind of John Grisham light. Yeah. He's got this small town lawyer, and it's based on Richmond, Texas, where we live and all. Spoiler alert: there's no sex scene in your book, but one of the questions I kept asking, and this is maybe because I'd had too many bottles of wine, did the CIO and Emily sleep together?
No,
they didn't.
No.
Okay,
that was definitely too much. That was definitely read into. That never even crossed my mind. No one else has brought that up.
Okay, so that's just me.
That was you desperately searching for what every novel should have sex scenes. And and this novel was very, what you read in the final draft was much more open than the first vision of the novel, which was even more austere, which was like, there's like a scene outside. There's like a scenes of like him smashing a computer. But in like the first draft, it was like almost all dialogue, very little he said, she said, just person come in and just like, and there's like some precedents. There's a contemporary novelist, Rachel Cusk, who does that about sort of broader life. There's a very hard to read novel called JR by this guy, William Gaddis, that was all this. So it's like a very, very like sort of, I set myself like this tight box that was like not even like a heartbeat. It was just all like brains talking about, kind of chasing alpha and doing it. And then it's kind of gotten more human, but I still, there's not a lot about his home life. It's kind of implied. It kind of comes in there. But again, there's, there's literary critic James Wood who talked about another book. He said it was like, the book was set in Botswana. Like Botswana was the fabric, not the backdrop of the novel. Like this one, I want to invest in to be the fabric, not the backdrop, just because resisting, the novels like literary thrillers that happen to have a Wall Street, kind of character in them.
Right.
And like, I'm, it's like, there's plenty of those books out there, and you don't need me to write that for you.
Because the reason I ask that is, if you listen to Brene Brown or read her stuff, pressure point for a woman is always body image. Yeah. Pressure point for a man is, can he fix things? And when we can't fix things, that leads to shame, our self-destructive behavior. And I really kind of lived that, during what our industry went through with the pandemic. Right. I jokingly say I became the Oprah of the oil and gas business, and I really did, because I'd go on the podcast, I'd have my priest talk about all the therapy I go through. So the reason I ask if he had the affair is you do a very good job of humanizing the CIO, and I related to him. I mean, just the pressures of the job, the self-doubt, he couldn't fix it. What are the quarterly numbers going to be? So it wouldn't have, I was waiting for potentially Emily to say, well, you shouldn't have slept with me that night, because he is verge of the bad behavior that shame brings out of all of us, unfortunately.
And and again, like, but it has all, it's like, has every human being, there's always someone more successful, right? There's always someone, and you always think like, sometimes, is he smarter than me, or did he just get lucky? Did he get lucky? And private equity, hey, that guy had an easy fundraise, and writing, like, this guy's had a career as a novelist, despite, maybe not being as good of a novelist as me. That is the career he or she has had that I've wanted. So there's a sense of like trying to really embody that emotion of like, I'm not a bad person. It's a lot, maybe it's ego, but it's also trying to contribute to the world, and the world doesn't really care. Sometimes, it's like the world can be mean. The world can be, and especially on the investing side, and I think, I'm probably, you kind of ham up, sort of like the industry during the days, but it was like you were still trying to generate good returns for your investor and being a very responsible person. Like sometimes it's
so when we signed the sale and purchase agreement for Silver Hill to buy the offsetting acreage that we bought, that was Silver Hill too.
Yeah.
I was sitting there staring at a model that showed a 50% rate of return, tripling, quadrupling my money, but it took $40 oil, and oil was at $31.25 when we signed that PSA, and I threw up that night. I mean, I really did. Not alcohol induced, like literally stress induced.
Yeah.
It's a real thing.
Yeah.
So I really connected with the guy.
Yeah, no, it's and just trying. Yeah, so that's purpose of and then people have read the book who are, one of the interesting things about the response to the book is there are some who are just like, and there's like new scenes that have been added to the front end to try to ease you into it, but like in its first austere phase, like you're just like thrown into a pitch, and it's like some people who read it are like, this is not even in English. Like it's like a private credit manager hotshot who worked at Apollo pitching a fund, which is now like the third scene or something, but it was like the first scene. And, and I tried to like, you watch shows all the time where you don't know what's going on immediately, or you listen to music and there's like a depth of creativity that you have no idea, like what even the instruments are playing, or like how that's done, and you still appreciate it. And so the one interesting reaction is there has been, because it's set in finance, it's like, I cannot read this, certain reactions. It's like, well, you can. Or it's like, I don't get, like my mother, stop reading it. She's like, I just don't. I was like, I really don't, it's like, that's fine. It's like, but it's like, I did want to say, it's like, I'm sure you could read it, and it's like, so trying to open up to a different language to that. And people who do get through it have said, hey, I still didn't understand. It's like, it's okay. I don't understand 15% of it. I don't understand 50% of most things I read, truly. But like people who've come from outside of finance are like, not only do I kind of understand this better, but also it applies to my life in very universal ways.
And I'll say it this way, and I'm not just blowing smoke at you. I think you did a nice enough job with it. It's like somebody that watches Shaun White snowboard for the first time. You don't know what the rules are. You don't know what that. You do know that dude is better than anyone else, and that was the whole thing. I mean, you were connecting with the CIO. You felt the pain he was going through, and the finance stuff in there is simple enough that you can pick up enough of. Oh, this guy's a blowhard. Okay, this guy's real. So, title of the book, where can people get it?
It's called The Counting House. It's not available. It's till November 15th, but you can buy it now. Amazon, Barnes & Noble, books. Like go online, just type Gary Sernovitz, The Counting House, and you could pre-order it. So you could be the first.
Nice.
And hit your Kindle.
Perfect.
On the second, it's available, and for basically for $18, it can hit.
You were cool to come on the podcast.
Thank
I
you.
really appreciate you doing it. The one thing I'm going to say though, I'm kind of pissed off. I didn't pick this bone with you because I wanted to. You used real live finance people names in your fiction book, and yet there's no Yates Capital.
Sequel. Counting House. It'll all be about Yates Capital, the implosion of a once mighty financial powerhouse, recrimination, self-loathing, and all that. I've seen it. Or maybe I'll just like steal lines from it. And
perfect.
It'll be a long lawsuit about life rights that I've stolen your life rights by.
Nice. Exactly. That's awesome. Gary, thanks for coming on.
Thanks for having me. I appreciate it.